You probably know someone pitching crypto as the fast track to wealth. Maybe it's your cousin sending you DMs from the closing shift at Applebee's, or that guy on a Tinder date who calls himself an entrepreneur but actually sells solar panels door to door. The movement has academic roots. In 1983, David Chaum introduced the concept of eCash, an anonymous electronic money system. It remained largely theoretical until 2009, when the pseudonymous Satoshi Nakamoto mined the very first Bitcoin. The promise was a decentralized, government-free network, a financial utopia that offered a direct rebellion against the traditional banking system. It was pitched as a digital middle finger to the banks that had just crashed the global economy. But 15 years later, the gap between that digital utopia and the actual industry is wider than ever. To find out if crypto is the future of money or a brilliantly engineered illusion, we have to look at the metrics that define every other asset class. To understand where the industry actually stands, we begin with a stress test of its primary claim, functioning as a real-world payment system. This chart compares global adoption. Of the estimated 350 million businesses worldwide, only about 18,000 accept Bitcoin. Even for those that do, the crypto is usually immediately converted back into US dollars by a payment processor the second the transaction clears. The mechanics are effectively broken for daily life. High transaction fees, susceptibility to fraud, and extreme price swings make it nearly impossible to use for groceries, rent, or a cup of coffee. This graph tracks annual volatility to evaluate Bitcoin as an investment. While the US stock market historically averages around 15% volatility, Bitcoin sits at roughly 60%. It is 4 times more erratic than traditional equities. Because the risk-adjusted returns are so poor, money managers overseeing trillions of dollars rarely recommend putting more than 1 or 2% of a portfolio into crypto. Warren Buffett famously looked at the underlying value and called Bitcoin rat poison squared. Without adoption as a currency and extreme instability as an investment, Bitcoin exists solely as a speculative asset with no intrinsic value beyond market sentiment. Beyond Bitcoin, the secondary market is even more volatile. Retail investors often gamble on a sea of thousands of altcoins and meme coins, hoping to pick a winner out of a digital casino. This pie chart illustrates data from CoinGecko, which tracked over 7 million coin listings since 2021. They found that 3.7 million of those coins have stopped trading entirely. Over half of the tracked assets in the crypto market are currently dead. If a traditional stock fails, shareholders might get a claim on physical assets. If a crypto project fails, or the developers rug pull and vanish, investors are left with nothing but a JPEG logo and an empty Discord message. To counter this volatility, the industry created stablecoins, tokens designed to stay tied to the value of the US dollar. The most heavily marketed of these was the Terra and Luna algorithmic ecosystem. Terra was pegged to the dollar, and Luna stabilized it. If Terra dropped below $1, the system minted Luna to push Terra back into equilibrium. But in May 2022, that mechanism failed during a sell-off. The peg broke, and $45 billion evaporated. It is an asset class where systemic flaws mean investors have a statistical coin flips chance of seeing their entire net worth disappear overnight. Even the platforms used to trade these coins lacked the security they promised. For years, FTX was the undisputed giant of the industry, marketed as the crypto equivalent of the New York Stock Exchange. They built a facade of institutional safety, using Super Bowl commercials, stadium naming rights, and billions in backing from elite venture capital firms like Sequoia. CEO Sam Bankman-Fried was the face of this trust. The industry called him a white knight, and the press labeled him the next Warren Buffett. The reality was that FTX was secretly siphoning billions in customer deposits to fund high-stakes trades at its sister hedge fund, Alameda Research. Their internal controls were non-existent. When the company went bankrupt, John Ray, who cleaned up the Enron scandal, stated he had never seen such a complete failure of corporate accounting in his entire career. The core infrastructure of the industry was built on blind trust, operating with zero oversight or regulatory controls. Despite all the massive bankruptcies, the widespread fraud, and the billions in destroyed wealth, the crypto ecosystem continues to thrive. There is a deep irony in the community expressing shock when these collapses occur. These are the predictable results of an ecosystem built specifically to be anonymous and unregulated. When you look past the technology, it operates on the same greed and insider schemes that were outlawed on Wall Street decades ago. It isn't a new frontier, it's an old scam in a new costume. After 15 years, the verdict is clear. Cryptocurrency is not a revolution in finance. It is a digital mirage that disappears the second you reach for it.